guys, this is Claudia here from the Bookkeeping Experts. I've been an accountant bookkeeper for a long time and I absolutely love what I do. And the reason why I love what I do is because of you. I love to interact with other businesses owners who wants to find out how they're doing and wants to bring their financial up to date so that they can understand how to take their business to the next level. Today we're going to talk about something that is very important to understand how to take your business to the next level. Okay, we talked in the past about QuickBooks and how you can bring it up to date, how you can clean up. But the most important reason why you want to keep your books up to date is so that you can look at your financials and have an understanding of how your business is doing. As I spoke before, that's your point of reference. You want to know where you are in order to figure out where you want to go. It is not possible to set a direction or a goal without knowing where you are. If you don't know where you are, you don't know where you're going. So you need to know where you are in order to know where you want to go. One way for you to do that is to run your profit and loss by percentage and find out what's the benchmark for your business. We're going to do a what we call a vertical financial analysis on the profit and loss today, and I'm looking forward to share with you how you can analyze your profit and loss in order to have a better understanding of how your business is doing. Okay, here we go. Without much further ado, let's go to QuickBooks Online. There it is. Okay, I'm gonna make sure I maximize this, and I'm gonna make sure I will move this picture someplace else here. All right. Okay, so here is my dashboard. There are some new features on QuickBooks Online that you can use. On a business overview, you can take a look at now keep in mind this is a sample company, so there's not a whole lot going on here, but there's some reports you can run and you can verify your bank accounts and your balance to see if it matches and so on and so forth. All right, so but what we're going is on reports on the left hand side. Click on reports. Now keep in mind that if you are on the business view, this is what you're gonna see. All right, so if you want to change it, as I talked to you before, just click on the gear menu and you can switch back and forth. And here is pretty much everything we have on the other one. Okay. All right. But I like to use, okay, there it is, business overview, and there it is, reports. Okay, so it's under business overview. So business overview right here, and then you got the reports. It's the same thing, it just looks a little different. To tell you the truth, I don't use this one very much, but usually I like the accountant view better, but that's how you do. Okay, so this is the basic balance sheet, profit and loss. But in order to do a vertical analysis, I want to do a profit and loss by percentage, okay, of total income. So that's right here, profit and loss as percentage of total income. That's how we run a vertical analysis of your business. We're gonna analyze the percentage of your or of your expenses and all the items based on total revenue. Okay, so we're gonna do it this year to date. And the first thing we're going to see here is your total income, where your income's coming from. Now, talking about income, you want to make sure you keep your income as simplified as possible. You don't want to complicate too much. You probably want to have maybe 5 income accounts, 6, somewhere around that. There, not too many. If not, it's going to get too confusing. I have clients that open an income account for each of their services, and that is a no-no. in order for you to track that, you can create your products. You can have 200 products and route those products into certain income accounts. And then you can, if you want to analyze what products are selling the most, you can, run a different report. But this one, you want, like I said, on the income, you want to keep it simple. You want to have maybe 5 to 6 income accounts. Clear up all the duplicates, clean up all the products. You don't want that. You want your product not as an income account, but as products, and route it to an income such as service or a sale of product or something like that. Maybe 5, 6 at the most. Okay, for this one, the sample company, we have a few accounts. We have design income, discount giving, landscaping service. So some basic service that it's provided, right? But no like specific products, because if you do it, you can end up with a income or profit and loss with about 50 different income accounts, and you don't want that, because it becomes the process of understanding your financial, it becomes completely impossible. So you want to keep it simple. All right, so you see the total income in here. There's a few income accounts on this one, and the total income is 100% is 10,277. That's our simple account from QuickBooks Online. And then there's cost of goods sold, and you want to take a look at the percentage of your income, and depending on your business, you want to take a look at cost of goods sold. What is cost of goods sold? What's the difference? A lot of my clients ask, what's the difference between cost of goods sold and job supplies? Cost of goods sold is the cost of you providing your service. Okay, so for instance, for a company that provides like an event company, for it provides DJs, videographers, and photographers, or whatever. So the cost of providing, for instance, a photography work, includes like maybe subcontractors, maybe the printing, shipping of a photo book, all things that are related to a job. If you have, for instance, a air conditioning company, the products that you buy in order to provide the service for a specific client. Now, supplies would be things that you cannot route to a service, would be some general items that you buy, such as nails or screws or whatever, maybe props for a photo booth company, for instance, or those are things that you buy that you're going to be using in several jobs, and you cannot target it to one job. Okay. And cost of goods sold is the other way around. So it's direct cost of you providing the services you're providing. For restaurants, for instance, food is huge, and it's a cost of goods sold, and you want to find out what's your bottom line, right? So you want to see what is your total revenue and what is the percentage of your cost of goods sold. Understanding your percentage of cost of goods sold on a restaurant business, for instance, it is so important, because if your cost of goods sold is too high, so that means you're not going to make any money, even if your revenue is really high. If your cost of goods sold is too high, it's eating all your revenue, or your profit, eating all your profit. So you want to make sure you keep a close eye on the cost of goods sold, and that's why cost of goods sold is all the way on the top, right after income, and then you're gonna have your gross profit. That means gross profit is your total revenue minus your cost of goods sold, the direct cost that you have to provide your services. Okay, so then you're gonna have the percentage of the other expenses, the operation expenses, and you definitely want to take a look at that, because you may find out either a discrepancy, or you may find out something that is incorrect. One thing that I've noticed, for instance, going back to cost of goods sold, for instance, I had a lot of clients which had very large cost of goods sold, but they were making money. And so what is the problem there? So the first question I would ask is that, are you holding inventory and putting all your inventory in cost of goods sold? And a lot of them, especially with QuickBooks sometimes not being so good with inventory, they'll say yes. And what does that do is that it takes away all your profit. So you're looking at your profit and losses, not showing the right numbers. So how to work around that? If you don't want to keep inventory with QuickBooks, that can be very complex and not very how can I say accurate. You can actually update. You can use a different software and integrate with QuickBooks, or you can manually update with a journal entry at the end of each term or each month or whatever. So you can put it in cost of goods sold, and then at the end of the month you can remove it from cost of goods sold and adjust it to account for whatever inventory you have at hand. One way to do it. Or you can put it all in inventory and then analyze it, cost of goods sold, or set up your books in a way that your products and service will take away from inventory. That's managing your inventory through QuickBooks. But if you don't want to manage the inventory, you can do that. You can put it all in cost of goods sold and then do a journal entry to remove that cost of goods sold that would be inventory and put it in inventory. And you want to do that at the end of each month, so you can have an accurate idea of what are you actually making in your business, right? Or what's your bottom line? You don't want to carry all your inventory in cost of goods sold, because that it's not accurate. And that's going to show probably a very high cost of goods sold, and maybe even can show a negative amount when actually you're making money. You're just carrying a lot of inventory that is there to be sold in the future. And inventory is an asset and is not on your profit and loss. It's going to be on your balance sheet. Okay, so very important. So there's a lot to talk about cost of goods sold. So after that, talking about your expenses, I would take a look at the expenses that have the highest percentage, but you also want to take a look at the small ones to see, if there is anything that is missing or anything that is miscategorized, right? Very important. So one of the things I would look, for instance, legal and professional fees, which is 11%, 11.47. I would go straight there and take a look if there is any discrepancy, make sure everything is correct. Another big expense for some industries is insurance, especially lately. If you carry, I had clients that provided transportation for customers with disability, and the insurance was so high. Right? So it's good to take a look at the insurance and see, one, to measure how that is impacting your bottom line, and two, to verify how maybe you can find better prices. You want to take a look at your profit and loss and see, wow, so this is taking away 10% of my profit. So what is that expense? What can I do in order to lower this expense? So very important. So very important to take a look. Take a look at job supplies. Make sure that the job supplies is at a reasonable percentage, right? Because if not, maybe there's something miscategorized, such as an equipment that should be an asset and not an expense. Keep in mind, verify with your CPA Make sure that whatever you're expensing there is supposed to be expensed, because if it is above a certain amount, usually $2,500, you want to capitalize that. Means you're going to put that as an asset and depreciate over the years. This is a question for your CPA. Okay, so don't consider this as a financial advice. Go consult your CPA to find out what kind of equipment should be going in your profit and loss, and what kind of equipment should be capitalized, means be put on your balance sheet as an asset. So that is not going to impact your income here, because if you have equipment, one is incorrect. You're not supposed to expense equipment that is above a certain percentage. Each state has a percentage that you can expense per year, right? So consult your CPA in regards to that. Please do so, and you don't want to put anything here that belongs in the balance sheet as an asset, right? Okay. Enough of that. Okay, so yeah, keep an eye on each percentage, okay, related. This is all the percentage related to your total income. So that's your total income. Automobile, for instance, here is 4.54%. That's pretty reasonable. Job materials at 7.87%. Now, to have a better idea of how you are doing, the idea is to find out some kind of industry benchmark. There's a lot of websites out there. I'm not going to tell you which ones, because I'm not sponsoring anyone in particular, but look for your industry benchmark. For instance, for restaurant, if your bottom line, if your net income it's above 15%, means you're doing pretty good, actually. Positive. Especially right now, there's a lot of pressure for restaurants because of the cost of goods sold, and also the labor cost. Labor cost is super high. It's really impacting the bottom line of many restaurants. So it is very important for you to take a look at your profit and loss and verify your percentage. But keep in mind, in order to get here, you want to make sure you clean up your books. You want to make sure you go through all the details, and you can actually have an idea of what needs to be recategorized by looking at your profit and loss, because you can find things here that doesn't belong. Like I said, maybe you can look at your cost of goods sold and verify that a lot of this cost of goods sold is not cost of goods sold, because it's sitting on your warehouse is inventory. So it should not be cost of goods sold. Should be counted as inventory, as an asset. Or, like I said, equipment. Maybe you have some equipment you expense here that does not belong here. Should be on your balance sheet as an asset and depreciated over the years according to what your CPA advised you to. But it's very important, because if you don't have everything organized on your profit and loss, you're not going to be able to understand where you are. What's your point of reference, right? So in this case here, our landscaping friend is not doing very good. It's an example, and hopefully that's not the case. It is a negative net other income, or net income. It's net other income is negative, so we're good here. So net income is positive. It's about 16.10%. So of course, like I said, this looks good, but depending on the industry, you may find out that your average net income may be too low, or maybe pretty high, pretty good, whatever it is. But in order to know that, find out your benchmark, your industry benchmark, and see what's the percentage of the net income in your industry. And if you're not measuring up with your industry, maybe you should be considered take a look at your expenses and verify what can either be cut or maybe adding some more advertising, SEO, whatever you need to do. Looking at this profit and loss and analyzing the profit and loss based on percentage of total revenue will give you a great idea of your point of reference. If you have more questions in regards to your profit and loss and you need a little bit of an expert advice, feel free to contact us and we'll be happy to help you with a one-on-one Zoom meeting where we can teach you how to pull out those reports and how to analyze them, and also how to clean up. We can teach you how to clean up, or if you want somebody to do it for you so you can focus on what you do best, yeah, you can do that as well. We can take care of your books and make sure that you understand how you're doing and ready to take your business to the next level. All right, if you like this video, give us a thumbs up. Give us a thumbs up and let us know what subject you'd like us to cover in the future. We want to hear from you, so let us know what would you like us to cover next time, and also subscribe to our channel so you can stay up to date on a weekly basis. We like to bring you QuickBooks Online free tutorials. This is free education. I took the time to research, to study, and gain as much knowledge as I can so I can share for free with you. So how awesome is that? So subscribe to our channel so we can bring that to you, and share with your friends, share with your co-workers, share with the world. And we hope to see you again. Subscribe to our channel. And until next time, keep on smiling.